Hello, investors, and welcome to your market briefing for November 6th. Wall Street took a major hit today with a pretty broad sell-off across the board. So what was the culprit? Well, it was a sharp pullback in the tech sector, combined with an economic warning sign that definitely got everyone's attention. So, what's really driving the turmoil today? You need to focus on three key things. First, the high-flying AI stocks, they took a nosedive. Second, we just got the worst October layoff numbers in over 20 years. And third, a critical revenue miss from AI darling supermicrocomputer. We're going to break it all down for you right now. All right, first up, let's just take a look at the closing numbers to get a real feel for the damage today. As you can see, it was a sea of red across the board, but the tech-heavy Nasdaq was the absolute epicenter of the pain, getting hammered by 1.9%. That tells you very clearly that today's selling pressure was laser-focused on the tech sector. Okay, so what was really behind this sharp drop today? When you boil it all down, there were two key factors that really spooked investors and triggered this wave of selling. The first factor was a really worrying signal coming out of the U.S. labor market. This is something that immediately put Wall Street on high alert, and it's flashing a warning light for the health of the overall economy. According to a new report from Challenger, Gray & Christmas, U.S. employers announced a staggering 153,074 job cuts in October. Now, that is a huge number, and for a market that's already on edge, it was like a punch to the gut. And just to give you some perspective on how serious that number is, we have to point out, this is the single worst October for layoffs we've seen since 2003. We're talking more than 2 decades. And believe me, this isn't just a one-month blip. If you zoom out and look at the bigger picture, year to date, we've already seen 1.09 million job cuts. That's up a massive 44% from the same time last year. The tech sector has been leading the charge here, making 2025 the absolute toughest year for the job market since the financial crisis back in 2009. Now for that second major factor, the market's biggest darlings of the year, the artificial intelligence stocks, they just ran into a sudden and painful correction. The sell-off was so fierce that it's got a lot of people on the street asking this very question. This quote from analyst Danny Hewson at AJ Bell just perfectly captures the mood. There's been this, quote, lingering concern about the sky-high valuations of these AI giants and the sheer amount of money being thrown at the AI dream. Well, today, that concern finally boiled over into actual selling. And if you want to see how this anxiety over AI valuations is playing out in the real world, we just need to look at one specific example, a key player in the AI hardware space, supermicrocomputer, better known as SMCI. So here's the thing, their earnings report was a mixed bag. On the one hand, their earnings per share absolutely crushed expectations by 25%, but, and this is the crucial part, their revenue came in just a hair under the forecast. In this kind of market, that tiny miss on revenue was the only thing that mattered. Why? Because for investors who are so hungry for growth, that revenue miss was interpreted as the very first sign that demand in the critical AI server space might be slowing down. You have to remember, this is the market that fueled SMCI's incredible stock run, so any little crack in that story gets magnified. And the market's reaction? It was swift and it was brutal. This week alone, SMCI stock plunged 25%. This is just a harsh reminder of how quickly sentiment can flip on these high valuation growth stocks the moment their growth story shows even the smallest flaw. So where does the market go from here? Looking forward, investors are trying to navigate through an increasingly complex and foggy landscape, with several key macro factors all in play at once. Right now, the market is watching 3 big uncertainties very closely. First, can they make progress on the government shutdown talks? That directly impacts economic data and confidence. Second, what's the real potential for a Fed rate cut in December? And finally, the Supreme Court is reviewing the legality of the Trump-era tariffs, which could reshape trade. Any one of these could dictate the market's direction in the coming weeks. And speaking of rate cuts, this comment from Fed board member Austin Goolsbee is very telling. He's expressing extreme caution, using this thick fog analogy to describe making policy when the shutdown means key employment data is missing. He's basically saying the Fed is flying blind right now. But it's not all pessimism out there. Some analysts, like Louis Novelier from Novelier & Associates, are still holding out hope. He thinks that the classic year-end rally is still possible, but only if the government shutdown and the tariff situations get resolved. All of this leaves us, after digesting today's volatile session, with the one crucial question that's on every investor's mind. Was what we saw today just a normal, healthy pullback in a bull market, or is it the beginning of a longer, more serious downturn? That right there is the million-dollar question hanging over the market as we head toward the end of the week.